It's a good day, a live look at the Dow this morning. You can see relatively flat, down 1 point, but just under the 21,000 mark overall there for the Dow Jones Industrial. We've got Steve Scranton here, who's the economist for Washington Trust Bank, in with us this morning live. And Steve, you know, I know yesterday it was announced that the Fed's raised the interest rates 0.25%.
Right.
Why did this happen?
Federal Reserve raised rates because they're confident that the economy is stable enough that they can continue their process of trying to bring interest rates back to normal compared to the depressed rates we've had over the last 7 or 8 years.
And Steve, when it comes to these raised rates, what does that mean for, the people out there when it comes to, credit card debt, car loans, your home mortgages? What does it mean? What does it do for that?
So I think what it really means is that anybody who has a mortgage that's tied to, a loan that's tied to short-term rates, they're going to see their rates go up immediately. So credit cards, adjustable rate mortgages, those type of rates will go up right away.
Okay.
I think auto loans will go up gradually over the next several months. But mortgage rates are more tied to long-term rates, and they didn't really respond to the Federal Reserve. So I think that they're going to be fairly stable, still in this 4.5%, 4.75% range for 30-year fixed.
And for the 30-year fixed. Now, if you have one of the variable mortgage rates, are you saying that those shouldn't? You're not going to see your payment go up, or you will?
No, the adjustable rate ones you should see. The only difference is if some adjustable you can lock in for a certain short time period. If you're in that lock-in phase, it won't change. But otherwise, you're going to adjust immediately as they change those rates.
And moving forward, Steve, what can we expect? I mean, is this can we expect to see them go up again? What kind of variables? What should people be looking for there?
Well, I think the Federal Reserve has been fairly clear that they want to begin to normalize interest rates, bring them back to more normal levels. They have forecasted they'll probably raise rates another 0.5% this year, and then continue into next year. With the goal to try and get them back maybe closer to short-term rates around 2% rather than 0. I think what you need to watch for, two things. If wages are starting to rise faster than they have been, then consumers are more willing to spend. That would cause inflation concerns. The Fed would raise rates faster. The other would be Congress, whether they actually start passing legislation that helps boost economic growth. Because the stronger the economy is, the more willing the Fed would be to raise rates quicker than they've been doing so far.
Certainly something we'll be keeping an eye on. Steve,
Definitely.
Thanks for your time this morning.
Thanks,
Appreciate you.